All right. Welcome back. The second weekly. Still haven't come up with a name yet. The
Yep.
podcast.
There you go.
The market update podcast. We should just call it the podcast.
Yep, the pod.
The pod. Well, I guess we can get right into it. I think the main topic for this week is September 16th. Tomorrow's the big day. We've got the Fed announcement coming out, commentary along with it. I don't know. What do you think, Nick?
I mean, I'm thinking 25 basis points like most everyone else, unless you're hardcore bull, I guess. But
Yeah.
yeah.
It's the 25 basis points. I think that's what it's going to be too. I mean, that's what everybody thinks it's going to be. That I think it was a 10% chance that there's a 50 basis point cut. I think that would be real surprising. I think one of the interesting things I heard this week was they did a study on Bloomberg Intelligence actually did this study where they were referencing, basically, is there a dispersion in the expectation for a rate cut or not a rate cut going into the meeting, and then if there is a cut, that's a big positive the next forward 1 month for the S&P 500 as the proxy. And then if there's not dispersion, like I would say we're in a position where there's not really dispersion. Everybody thinks it's 25 basis points, right? So basically the forward return is zero. I think it was like 0.05%, something really, really small, which does make sense. Like when it's expected, equity markets do a really good job of pricing in what's about to happen, especially if everything is in line with the consensus. So if that is the case, I don't know. I mean, you still could have a good amount of volatility around tomorrow. Probably more driven by the commentary than anything else, though, unless we have some major surprise and we have a 50 basis point cut or they don't cut, then equity markets could see volatility without the commentary. But I think the commentary is probably the most interesting piece, at least for me tomorrow.
Oh yeah, absolutely. I mean, like you said, I think pretty much all of the market is pricing in 25 basis points. It'll be a little bit surprising if we get anything else. I'm definitely interested to hear the commentary, like you're talking about with Powell, especially with some of the data that's been coming out recently, revisions specifically with jobs data. Also, just interesting inflation data coming out, not necessarily a cool inflation situation we've got going on right now. Definitely some inflationary pressures, along with potentially a weakening jobs market. So really think his commentary is going to be super interesting, especially hopefully getting some insight into the path forward.
Yeah, no, I totally agree. It's a difficult time to be an asset allocator. I mean, you're looking at, a period where stocks are at all-time highs. We're, not in a recession, and the Fed is going to start cutting apparently tomorrow. So really, I mean, I find it difficult just because there are a lot of, it's kind of an odd scenario that we're in at this point where we're cutting into all-time highs. What does that mean? It For me,
Absolutely.
yeah, the other thing that's interesting, Strategist did a really nice study. I think I've showed this to you before. I don't have it, ready to pull up or anything, but um, it does they studied beyond since the financial crisis. They studied a much longer period here, but basically we're studying the instances, the different cycles, and they're studying basically the most bullish time, the biggest positive returns for stocks were from the pause to the next cut. That's the time when stock markets did the best in terms of total return, which would mean that we're kind of ending that period. We're kind of ending a period. If we're going into another cutting cycle here, that maybe that is not good for stocks. But at the same time, I don't know. This is an odd environment where we're not in a recession. We've got some um there's so many different variables. It's hard to pick which one you're going to side with and just pick, which is what makes it so hard to be an asset allocator at this point.
Absolutely. And I mean, to complicate that even further, I'm sure you saw it, but Anna Wong, the one of the head economists for Bloomberg, I think, published a report recently, basically theorizing that we had a recession last year. And I know there's a bunch of different definitions of recession. And technically, we didn't get 2 negative quarters of GDP growth, but at least weakness, enough weakness that in her definition, or for the purposes of this study, she was saying, potentially we had a recession at some point last year, and we're actually kind of at the beginning recovery stage of a business cycle right now, which would be really interesting if we're going into a rate cutting cycle. Also, while we're at the beginning of the business cycle as well.
Yeah.
And we're at all-time highs right now, which doesn't really line up with the traditional, business cycle model, or what you typically expect with it. But that is kind of the funny thing about the business cycle. They, talk about it in a textbook, and it's like, oh, this is like really easy. You just need to find where you're at on the cycle, and you just got to follow the rule book. But that's the hard part. Where are you?
Yeah, where are you in the cycle? You don't know until after it's over.
Exactly.
Yeah. What are you doing? What would you do in your personal accounts now if you're and obviously I guess that's a loaded question in some senses, because what I would say you are doing, what I'm doing in our personal accounts, we're translating into the accounts that we manage. But how are you thinking of things in terms of asset allocation for yourself?
Yeah. I mean, as a younger investor, definitely equity heavy. I'm not going to go 100% fixed income or anything like that at this point right now, at least. But that being said, they've gotten a little bit more conservative, for sure. Particularly in accounts like an HSA account that we can buy whatever we want, and that's a nice little thing that we have. But particularly like in an HSA account where potentially there's some outflow at some point in the near future if something horrible happens and I have to pay a deductible or something like that. So certainly de-risk that a bit, going heavier into fixed income, but in equities, for my outside accounts, outside of something that's likely to get spent in the immediate future, definitely leaning towards value companies, just because I have a hard time buying S&P 500, especially the top market cap portion of the S&P 500. Despite those being great names, they're just really elevated right now. I think there's a lot of uncertainty still in the market. Even going into a rate cutting cycle, which I get is totally almost counterintuitive to be avoiding growth assets, or those more risky assets. Leaning more into value. New money that I have is going into value equities, or some sort of income play, for the most part. So that's kind of where I'm at. What about you?
Yeah, I'm in a have a similar mindset, and I think similar to what we're translating for clients, where we have the latitude to make decisions on, the relationship between equity and fixed income, and what ratio we think is ideal. I think just within equity overall, like I've been a little bit more defensive, uh, trying to find cheaper stocks, whether that be international, whether that be in the US, et cetera. Again, not completely, dumping all of these higher valued companies. I think that that's not necessarily the place I want to be in, but definitely leaning away, especially with new cash, allocating towards dollars that are maybe going to cheaper companies that aren't quite so expensive, and towards some either cash or fixed income. I think that makes a lot of sense. Like we have for a while in our tactical portfolios allocated more heavily to fixed income, which I've been happy with and I continue to be happy with. I just think that if you we were looking at this earlier, and I think you even put together a chart on it. The, I mean, stocks are just, especially market cap weighted indices like the S&P 500, they're expensive, and especially when you compare them to bonds. I mean, it's a tricky comparison to make between how expensive our stocks versus how expensive our bonds, because you don't have something like a PE ratio or a price to sales ratio or price to book ratio that you could directly compare. You kind of have to look at, well, where are they in terms of price versus all-time high? Obviously everybody can see the S&P is at an all-time high or near an all-time high, but bonds, it's not necessarily as prevalent in the news media, but making that comparison is really difficult, and we came up with a neat way to do that here. But it's just it's a difficult one, but generally speaking, I think we're in a position where um stocks are really expensive, bonds are relatively cheap, but that's where you know I guess that's a hard comparison to make, somewhat. But I don't know. What are your thoughts on that?
Yeah, I mean, absolutely. Definitely becomes a little bit tricky to compare, but I think what we see here across the board when we're looking at bonds in particular, uh, just seems to be relatively more attractive than equities. Now, obviously, fixed income does not typically have the returns that equity does. So by no means are we saying let's dump all of our equity, let's pour into fixed income. But that being said, right now, if you have some leeway as an asset manager to take on a little bit more fixed income as opposed to equity right now, potentially adding some fixed income to your portfolio, so adding some fixed income exposure makes sense. Not only to reduce the standard deviation or risk of your portfolio, or I guess maybe downside deviation would be the goal there, but um, reducing some risk there, but additionally just buying a relatively attractive asset class right now. So like we were talking about, a couple of the metrics that we look at for valuing equities versus bonds, the percent off highs is a great way to start. Where are we versus where have we been? Um, Bonds just haven't fully recovered since 2022, when they really sold off. So we're still recovering from some movements earlier. And in addition to that, another interesting piece, and we were talking about this earlier today on another market call that we were doing, but just taking a look at the difference in dividend yield and coupon yield on the S&P 500 would be a great example, again, because we keep on talking about it, being a market cap weighted index, getting particularly concentrated and particularly expensive. But comparing that to the dividend yield, and I say dividend yield here because we're having to use ETFs as proxies for the underlying indexes. But comparing the yield of something like the Bloomberg aggregate versus the S&P 500, and what we can see here is that there's a growing disparity between the yield of the Bloomberg aggregate and the S&P 500. So you can see over here towards the left of the chart, since 2016, kind of been moving in lockstep. Definitely getting a little bit more yield, direct yield, from something like the Bloomberg aggregate, but staying kind of closely in a range with the S&P 500's dividend yield. And then you see here in about 2023, things just really diverged, and equities largely become more expensive, so decreasing that dividend yield. And yields went up on fixed income. So we see this big divergence. We're going into a rate cutting cycle, which typically is good for fixed income because yields are going down, prices are going up. It just seems like a good place to be right now, like a relatively safe bet to make.
Yeah, I agree. I liked looking at that. I like looking at those numbers. I think they make sense I think a couple of the conversations that we have had when we've talked about, well, how are you're saying equity is, expensive relative to fixed income. How do you make that comparison? Well, that's, in my opinion, that's one of the best ways to do it is looking at the average. It's a relative thing. It's not just the absolute numbers are not as informative as looking at that relative spread. Like where are dividend yields now? They're very low for the S&P 500. Ag bond, using as the proxy, the yields are notably higher. But even if yields come down, again, if dividend yields on the S&P 500 continue to be compressed, which is mainly a function of the the price. That's the main, especially when you're looking at an index, you're looking at the yield, the payout ratio is very stable usually. I'm looking now just at the dividend payout ratio for U.S. stocks, going back, scrolling back throughout time. I mean, it's ranging between 25 and 27% consistently. There's a 28%, but I mean, you're very, that's fairly, the dividend yield, the biggest input in terms of how that's going to fluctuate is going to be the price. So, you know, when dividend yields are as low as they are now, and they have really fallen on the S&P 500 as the prices have gone up, and it's just, it's an expensive index. But compared to compared to bonds, it's really, bonds do look cheap. They do look cheap, and it's an opportunity. Again, like you said, Nick, we're not advocating for dumping all equities. I think that's an easy understanding that some could take from this, and that's not at all what we're talking about. But there's an opportunity to tactically overweight to fixed income and look for, hey, if you do get a pullback, that fixed income should hold up better and be an opportunity for you to rebalance if you're trying to be tactical into, equities. Maybe you can buy those equities for those top names at a much cheaper price after a pullback. And then within equities, like we talked about, just be getting a little more defensive, just looking for some of those cheaper stocks that would presumably have a higher dividend yield. But that's a good metric in my opinion to do a comparison between equity and fixed income, which is somewhat difficult at times.
Absolutely. Yeah, definitely some good risk-adjusted return that's on the table with fixed income there, but that doesn't necessarily negate the returns, the overall returns you get from equity, especially with an aggressive client. But definitely some interesting stuff going on.
Yeah, you by default, if you're going to rotate in and out of it, whether it be all stocks and you're rotating between growth and value, whether it be, a stock and bond portfolio where you have some, latitude to move up and down in equity fixed income exposure, presumably that's a tactical client, right? So the client that just wants you to get, market cap exposure and just that, obviously forget about all that we just said. This podcast, I guess, is not for you. But I mean, I guess in that case, any market commentary or podcast is irrelevant if that's the case, right? Presumably, every person that's making asset allocation decisions has some type of asset allocation decision to make that's somewhat active, unless you're literally just 100% of your money is going into the total stock market, in which case, no point in listening to any of this because you're just going to get the market return and that's it.
Yep, absolutely. I'd imagine that the really passive managers, they probably like to watch the active managers and laugh sometimes.
Probably. Probably. I always find us in an interesting perspective because we service so many different types of clients, right? We have clients that we have a passive mandate and some that we have a more active mandate. And, it's interesting to see the different perspectives and the different approaches that clients have with us trying to, at Revisor, trying to be a facilitator for those clients to make sure they get what they want. It's always interesting to see the different perspectives.
Yeah, absolutely. Absolutely.
Well, we've got an interesting couple of days coming up, especially tomorrow. I'm really interested. We'll see we'll see what we think in a week from now when we revisit all this stuff and actually see how the dust settles after the Fed tomorrow. So definitely lots to pay attention to, mainly tomorrow on Wednesday.
Absolutely. Yeah. And I think one of the interesting things, this is kind of going back to what we were talking about earlier, but one of the interesting things I noticed, typically at the beginning of a week, we prepare a market report for one of our clients where we take a look at the performance of our portfolios and that sort of thing. And saw a lot of interesting movement in the small cap space last couple of weeks, actually. just I don't think we got a chance to talk about this on the call, but typically in small cap, because a large portion of the Russell 2000 is actually unprofitable, one of the screens that we add to it as a value add is looking for profitable companies. And over the past couple of weeks, in the anticipation of rate cuts, um, you see that those unprofitable companies actually seem to have a little bit more of a benefit than the profitable companies, which, when you think about it, how much of their operations they're financing with debt in all likelihood, it makes complete and total sense. But just that's a little bit more of a niche point there, but something that popped in my head that I thought was interesting.
Yeah, yeah, definitely. Definitely. It'll be very interesting to see how small cap behaves over the coming week if we do get rate cuts, and especially with the commentary coming from the Fed. So lots to pay attention to there.
Absolutely.
Well, I think that's it for this week. You got anything else? Any closing thoughts, Nick?
No, I mean, aside from when are we doing our gold bet? When are we starting that?
I'm ready to start whenever. Maybe we
Okay,
can
let's
make
do
that
it.
happen the next week or two. I'm ready to do
Let's do it.
it.
Let's do it.
Sounds good. All right. Well, until next week. Thanks, everybody.